Hey there, Alisado with Simple Option Strategies. Just want to let you know that this video is about 0DTE, and for this particular session, I do want to first cover what an SPX credit spread is. Secondly, we're going to talk about risk management and daily routines as it relates to 0DTE. Third, the basic 0DTE trade plan, which I've made some changes to already. And then finally, my November and December trade. All right, so please be sure to subscribe and like my channel. That really motivates me to keep making great content. And with that, let's get going. Okay, so let's start out with what an SPX credit spread is. An SPX credit spread is a combination of two puts and two calls where the put or call that is sold is more expensive than the put or call that is bought. In this particular example, we have one contract. It's called a vertical because it's strike on top of the other. SPX 100 really doesn't relate to 100 stocks. It really relates to 100 shares per contract. And so in the SPX cash index, there's 100 shares per contract, and this is the expiration date, 7 February 22. 43.85 is the put that you are selling. The 43.70 is the put that you're buying, therefore receiving a 60-cent credit depending on where the market is. This is called a bull credit spread. So now, again, you're selling the 43.85 put and buying the 43.70 put. Now you need to understand too the risk reward in this trade. So because it's 15 wide, 43.85 minus 43.70, right? That's 15. This margin is required. It's $1,500 per every contract. And the premium that you're receiving is 60 cents. So you're putting up $1,500 to receive $60, okay? And that's a pretty bad risk reward. And your max loss in this particular trade is $1,500. If it goes through both the 43.85 and 43.70 and ends up lower at the end of the day, below 43.70, that's a max loss, just so you understand. And anywhere in between there, it's not a max loss. It would be depending on how much it went down. So let's say the market ended at 43.80. Well, that's 5 points down. You would have lost $500 instead of $1,500. So that's kind of how that is settled at the end of the day. All right, so let's talk about option decay because this is really important and it's the main thing that's used in getting profitability on these trades. And this is an example of call options on the SPX. From 68 days to 33 days, the rate of decay is 34%. From 33 days to 5 days, the rate of decay is 57%. And from 5 days to expiration, the rate of decay is 100%. So you can imagine on the last day that the 0DTE trade is operating, it loses all of its value. That's why we call it 0DTE, 0 days to expiration. So that's kind of how the rate of decay works, and it works in all kinds of options. So I like being a seller of options rather than a buyer, right? Let's go through risk management real quick. Always trade with a plan. In a highly trending market, trade in the direction of the trend. That's just the right thing to do. And size your trades to ensure that emotions are not part of the decision-making process. I always say trade small and trade often because trading small, you don't have a huge emotional attachment and you can make constructive decisions rather than ones that are emotional. Trade often is because that's how you develop experience. Pre and post market routine real quickly here. Review areas of support and resistance because that's how I figure out where that I'm going to take a loss on my trade, identifying those areas. Review ES futures, the trending direction, because SPX doesn't trade all night long. It trades during the day. And then ES trades basically all night long from Monday through Friday. Determine your credit spreads before you actually enter your trades, before the market opens, so that you have an understanding of where you're going to put those trades on. Very important. Post-market, determine if rules were broken and why. You don't want to be breaking your rules, and if you do, there must be a reason, and hopefully it's a good one. Determine if tweaks or adjustments to your trade plan is necessary, and update your trade journal with your findings. Especially as a new trader with a new strategy, you want to keep a trade journal and make sure that you're doing the right thing all the time. So let's talk about the real trade plan here. I enter within 1 to 5 minutes of the market open using 15 wide or wider spreads. Typically it's 15 wide, and I am testing different ways of being able to possibly roll trades using wider spreads, but that's beta right now. I still close out my trades, and I do have examples of not closing them out and getting possibly a max loss, and I'm going to share that with you too, just so you understand how all of this works, okay? Majority of trades should be put credit spreads, and the reason for that is because the market generally is going up. And the second reason is because your put spreads are going to be much further out of the money from your call spreads. It's just the way it is. The strikes are much further away in the market for put spreads than they are for the call spreads. And so keep that in mind. And that's one of the reasons that I trade mostly put spreads. Wider spreads provide a greater distance to the market in price. We mentioned that already. Premium should be between 50 cents and $1 for the 15 wide. That's what I do. A lot of times I'll put on the 50 cents. Market will go down. I'll put on 80 cents premium, and then I'll put on $1 premium. I've done that over and over again, and it works really, really well. You got to just understand where your loss point is and make sure you pull the trigger so that you won't get a full max loss on that. I take profit between 10 and 20%. Most of the time I take 10 cents. Depending on where the market is or what's happening, I'll take a higher premium, less profit, but getting out of the trade is important. Expiration for a 20 to 25 spread is easier to let it expire because you're a lot further away from the market, okay? Exit or stop loss is identified in breaks and support and resistance for me. Other people use 3x credit, but sometimes I will take a trade off if it's continually moving in the wrong direction so that I won't suffer a max loss. I think we have time for 6 trades, and let's get going. This is November 1st, and the first trade I put on is an iron condor. So I sell to open, 1 iron condor, and these are the call strikes and these are the put strikes, okay? And I collected $1.10 for each side. On the market, you can see here, right after I put that trade on, it went down pretty aggressively. And when I put on that 0DTE trade, I always put on a close trade to make sure that when the market does its thing, it's going to close out my trade and I don't have to worry about it. I closed that trade, and then you can see here where the market went down, found support here, and started moving higher. And I decided when I saw this candle here that it might be going down, and eventually it did. You can see here, and it actually broke support. But I decided to close the trade because I had a nice profit already on both sides and close it out. I made $66.94. And so I keep track of my commissions and fees and include it in here just to keep it real. Let's move on to November 3rd. I am pretty sure this was a Fed day, okay? So I put on a trade, and I don't normally put on trades on Fed days, but I've learned that, since Fed day, they do the announcement at 2 o'clock, I can get decay before that time. Now, something else that happens during this time is that when it gets closer to 2 o'clock, you'll see the premiums start to inflate. And so I wanted to make sure that I got out of this trade before that time, right? So I put on a small trade this day and actually got out at 30 cents and was able to close it. And you can see what happened afterwards. The market ripped higher and went up to 65, which was the strike price of that particular trade here. And I'm glad that I got out of it. And so this is another reason, again, that I don't let trades expire, because you just don't know what's going to happen at the end of the day here, all right? There's volatility at the beginning, there's volatility at the end, and I like the middle and getting out before that, right? So I collected 23 bucks. Not a great day, but at least it's a profit. Keep in mind too, during this time I was trading 1 contract, 2 contracts, that's it, because I didn't have a great history on 0DTE trades in 2021. But it's a phenomenal trade, and I'm really putting a lot of focus on it now to make it much better, and things are going pretty good. But you're also going to see some bad things, so make sure you subscribe, because I'm going to include the good, the bad, and the ugly. Very transparent. This is trading, and you're going to see a couple ugly ones. Okay, so on November 5th, I put on this trade at 933, call side. You can see here where the market gapped, and I decided that we probably had a good chance that it would gap, go up a little bit and come back down. Put it on at the beginning of the trading session and then let it go up. I'm not a genius here, okay? Yes, I caught the top and I got lucky. That's what I'm going to give it. So got up to the top and I put on a $1.10 position here. And you can see here that we're at 417. So I had a good ways higher, for this thing to go. If it did go any higher, I would probably taken the loss. But anyway, the market reversed here, pretty strong candle down, and I was able to get out of this trade here at 10 cents because the market really aggressively moved down and then started moving back up again and got out of the trade at 130. So nicer profit here, $133 because of that 110 and 45 and getting out at 10 cents. Now this is November 8th and I put on a call spread again and collected 50 cents, went up and it collected 95 cents. Now you can see here that at the beginning of the day, these premiums really can spike. They can go a lot higher in a very very short period of time. After the day goes on, the premiums tend to really soften up because decay has come in. Now, the market went down and I caught the stem here on this candle and I stood out for 10 cents. So another decent gain on this one as well. Next trade, this is November 10th. I put it on right at the beginning of the day and I collected 50 cents. The market didn't really want to put on another position here. So I let it run and eventually the market went down, and you can see here that I was able to close it out very nearly where I put it on. And that tells you that decay is happening throughout the day. And even when the market goes down, because typically when the market goes down, there's a spike in volatility, and even the call side tends to hold that premium while the market's going down. But obviously it gave up and we collected this and got about 40 bucks on this one. November 12th, I put on a put spread, and then I put on another put spread when it went lower and collected 85. So I collected 50 cents and 85. And after that, the support held and the market just went green, 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 green. And I was able to get out right at around 11:30 or 11:17 for a 10-cent close on that. Okay. Another $113 gain on this one. So that covers our trades for this session. On the next 0DTE session, I'm probably going to cover 10 to 12 trades, go through those, maybe more. We don't want to go in too long, but hopefully this was of value to you. And again, I'm going to be sharing with you every single 0DTE trade that I put on so that you'll get a good education and understanding for how I trade, and hopefully that'll help you as well. So thanks, and hope you enjoyed the session. And remember, click on that subscribe button so you make sure that you get all these 0DTE trades, and like so we can deliver this great content to you. All right, have a great day, and we'll see you next time.